Hello there, friends. This is Hartaj from Ncaacademy to bring about a very interesting topic to you. What will happen to the financial markets in the coming future and how we can predict it. अभी आपके सामने recently इस हफ्ते दो major crashes रहे. One is the Japanese indices, which were Nikkei, which crashed by 13%, which has been the biggest crash ever in a single day from 1987 onwards. The second crash happened in the US markets. Well, that altogether had a different reason. Now, the question comes, how can we predict all this? And how does monetary policy have an effect with the financial markets? We are going to discuss this in detail. Let's start with the US. What caused the crash in the US market is two factors. One was the job data which came through, which showed that the number of unemployment has suddenly increased to a recent high in US. And the second was the threat of inflation. How did this come into existence? And let's understand it. So, whenever there is a threat of inflation, what does a central bank do? It increases the interest rates. As the interest rates increase, so automatically what happens? The inflation tends to reduce. How does the inflation tend to reduce? Let's understand that. It means lesser investment, because if your interest rates are more, so automatically people are not going to invest money. Lesser investment means the aggregate demand are going to reduce. If the aggregate demands are reducing, it means a reduction of labor, which automatically means that the labor will ask for lesser money for work. So wages automatically reduce. If the wages have reduced, automatically the demand reduces. If the demand reduces, automatically inflation is brought under control. That's how the financial institutions, or when we say the central banks, control the inflation. There's been a lot of criticism related to it. So what have the economists said? That why should the unfair burden go to the workers? Alternative could be that the companies should now start reducing their profit margins, and similarly they should break up their monopolies, and the government should work in such a way that the monopolies break up rather than putting this step. What is the current scenario in the US? We saw in the current US what had happened. The job data came through, which basically said the number of employment rate has decreased, or we say the number of unemployed has increased. Fearing such a thing, recession fears came into the market, and large amount of selling of equities happened in the share market of US. We had Dow Jones going down, we have S&P, Russell 500, all these were going down. Similarly, the second reason for this sudden sale was the less than expected results of the big IT firms that were there. We saw Nevada not performing up to the mark. We saw Microsoft not performing up to the mark. We saw Intel not performing up to the mark, which led to this sudden selling of the equities. Let's talk about the first factor that we were discussing about the unemployment. There's a rule known as SAM rule, SAHM rule, which is there. According to which, if you break down a certain amount of unemployment rate comes in, then the government, what it does, it starts sending checks to the household, and it starts putting burden on the thing, and it just indicates but does not mean recession has come through. This indication was strong enough sentiment for the people in the financial markets to sell off the equity shares, which caused this crash. Another thing, it was mere speculation. The markets work on mere speculation, thinking of economic crisis or recession. In US, this happened. Similarly, when we talk with the US bank, it is trying to keep its inflation data in check, so it is trying to not reduce its this mere speculation on the basis of which that a recession is coming, that people decided to sell off their equities in US, where the Fed, the US main central bank, decided to not have the rate cuts. So why? Who has to keep a control of the inflation? So if you need to keep a control of the inflation, what do? You increase the repo rate. As soon as the repo rate goes up or the rate goes up, the markets are going to have a sell-off. Now let's talk about the Asian markets. What happened in the Asian markets, especially in the case of Japan? In Japan, it was a very fascinating case. What the central bank did, it increased the interest rates, which were generally, very, it was marginal to zero. It had increased by 0.25 base points. So what is the reason for it increasing? Here, the Japanese central bank said, we are facing economic slowdown, so for that we need to increase the interest rate. So what happened with this? This is what happened. There was a carry of trade. What is carry of trade? Let's understand it. In this case, what happens is the money from the central bank of Japan is borrowed, and these investors tend to put the money in the markets outside, like in the US and everything. They decided to put the money in. As soon as the Japanese bank decided to introduce a bit of interest rate, so what happened is huge sell-off came in the foreign markets, because now they had to offset the borrowing cost from the Japanese bank. This led to the entire crash in the Japanese markets, which was 13%. The next day, the recovery was around 10%, but then again, it was a huge crash. And here, the reason was opposite. Now, the same thing like this happened in the Indian market. Let me give you a scenario of it happened in 2008 when there was economic slowdown in the US. The US Fed Bank decided to reduce this interest rates. So when the interest rates were less, the investors from there took the money from banks as loans and decided to invest in Indian markets. As soon as the US decided to increase, or US Fed Bank decided to increase the interest rate, what happened was a huge sell-off in the Indian markets. This is what we call as the taper tantrum. So I hope you've understood how the markets tend to react, and you'll be able to easily predict with the Fed policy or any of the central banks when they take out certain policies, how it has a certain impact on the financial institutions, and you can very easily predict a crash or an increase in the investment beforehand. I hope you've enjoyed the video.